Hello everyone! This week we are starting a new topic, the time value of money, compounding and discounting. These are some of the key principles and concepts in finance. You will really need to master these techniques because this is what you are going to use all the time in your future professional practice in accounting and finance. Hopefully by the end of this week you should be able to understand these concepts, their meaning. You should be able to memorize the formulas and mathematical tools which are used in order to compound and discount. You will be able to calculate future and present values of different types of cash flows: lump sum, unequal cash flows, annuities, perpetuities, and so on. And most importantly, you should be able to start applying your understanding, your knowledge of time value of money and related concepts to make relevant business and personal finance decisions. This is our study plan. Let's begin. In accounting and finance, you will use the terms assets and liabilities all the time. And if you started doing some other modules in accounting, you know that assets represent a significant, very important part of any company's balance sheet. So what exactly are assets in finance? Strictly speaking, an asset is simply a source of cash flow. It's something which can generate cash flow. If it doesn't, then it's not an asset. So strictly speaking, the ultimate purpose of any investment is to get cash flow from the acquired assets. You try to buy, to purchase assets, you invest in something in a hope that it will generate some cash flow, some income in the future. For example, if you invest in real estate, you will get a rent. This is your cash flow. If you invest in financial assets like stocks, shares, bonds, etc., you will get dividends, you will get certain yield in the form of coupon on your bonds, and you will also get capital appreciation when you sell your stocks or shares. If you invest in businesses, in physical businesses, you will get profit. If you purchase some commodities like gold, you hope to achieve certain capital growth. You are hoping to be able to sell these assets later in time and enjoy some capital growth. So assets in finance is simply a source of cash flow. And finance is the study of those cash flows. What investors are actually doing when they invest, they are buying a stream of future cash flows. And our task as an investor or as finance manager in any company is to maximize these future cash flows. And apparently we should be able to forecast them, to calculate them, and we need to be able to calculate the values of these cash flows at different points in time. And in this particular lecture, we will learn a few techniques which will help us to understand how we can value these cash flows. And in order to do so, we'll need to learn the concept time value of money. We need to be able to appreciate the time value of money. This is a basic finance concept which attempts to establish the equivalence relationships between cash flows occurring on different dates at different points of time. In simple terms, it simply states that money today is worth more than the same amount of money in the future. This is what time value of money is. Money today is more valuable than the same amount of money at some point in the future. Just to give you an idea why this is the case, just to make it easier to understand, let me ask you a simple question. Would you prefer to receive a payment of £100 now or 1 year later? Now or later? Apparently now. Why? Just think about this for a minute. Why is this the case? The thing is, the same amount of money today is more valuable rather than in the future due to various factors. First of all, our own consumption preference, our impatience. We prefer to be able to spend this money now. We as human beings prefer instant gratification. We don't really want to delay our gratification, our satisfaction, certain utility which we can derive from spending this amount of money. That is why we prefer to have money now rather than later. Apart from this, majority of countries suffer from monetary inflation. Even if it's small, it still devalues our money. This is what we've learned in the macroeconomics part of this module. When the country experiences inflation, it implies that the purchasing power of any sum of money declines. And the higher inflation is, the greater is this loss in purchasing power. And because of this, £100 today is more valuable than tomorrow, because tomorrow prices of real goods will be higher and you will be able to purchase less. The purchasing power of these £100 in the future will be lower. That is why you prefer to spend it today. You will be able to purchase more. You will be able to enjoy higher purchasing power in real terms. Apart from this, there is certain uncertainty or risk associated with future cash flows. For example, if someone promises to pay you £100 1 year from now on, you cannot really be certain that they will pay. What if they don't? What if they will become bankrupt? What if they just forget? What if you cannot get hold of them 1 year later? In other words, you would rather avoid this risk. You would prefer to have it now rather than later. All of these factors will reduce the value of future cash flows relative to present cash flows. The same cash flow today is more valuable than cash flow tomorrow or at some other date in the future. And most importantly, in finance, time is literally money, because time gives you an opportunity to earn interest or some return by delaying consumption. If you have £100 today, you can invest this money and you can receive a greater sum 1 year later, because you can earn interest or some other form of profit, some return on your investment. That is why present cash flows are more valuable. Let me give you another example how the time value of money works. Let's imagine that you've done some work. For example, you worked as freelance accountant and you are offered 2 ways in which you can be paid. They can pay you £1,000 now, or a bigger sum, £1,100 1 year later. What would you prefer? Which option should you take? It's clear that if you were offered the same amount, you would prefer to get them now. But they're offering you to pay you a greater amount 1 year later. How do you make a decision? Just think about this, stop the video, maybe write down your answer, think how you would make this decision, and then proceed. Ready? Okay, let's have a look. Here is how it works. Here is the answer. Generally, you need to compare the potential return which you can earn by delaying this payment with the rate of return in an alternative investment. Have a look. This payment, 1,100, in fact represents 110% of the original amount. In other words, you earn 10% return by delaying this payment. This is a kind of your return on investment. And now the question is, are you able to earn a greater amount elsewhere or not? If you can make a greater return in an alternative investment, for example, if you simply take the sum now, put it in a savings account or in stocks or bonds or somewhere else, and you will get a greater profit, then you would prefer to get £1,000 now. It's better for you because 1 year later you will be able to have a greater sum. You will be able to generate a higher return rather than what you are offered in this particular case, in this particular scenario. If, however, you think that you will not be able to generate this return, maybe you will be able to make only 9% or less, then of course you would prefer to go for this amount. You would prefer to get this payment later, because it implies that during this period, during this 1 year, you have increased your capital by the best possible amount. You have got the best possible return on your initial sum. In other words, your choice between these cash flows, they have different value in different points of time, depend on the investment return which you can get on £1,000 in the current market environment. As you can see, interest rate plays a very important role in financial decisions. And in the rest of video lectures today, we will refer to interest rates all the time. So let's have a look at what interest rates are, what forms they can take, and how we can apply different interest rates to various calculations, to compounding, discounting, and other techniques.